All right, moving on. Now, the global oil market is facing a double shock. OPEC has cut its demand outlook, citing the economic impact of the conflict. But even as demand is revised lower, supply is collapsing far more sharply, triggering a widening gap between how much the oil world needs and how much it can actually access. OPEC, which accounts for about 35 to 40% of total crude oil production, has lowered its global oil demand forecast for the second quarter by 500,000 barrels per day. But the bigger story is on the supply side. OPEC's crude production has plunged by a record 7.56 million barrels per day in March. That's a decline of nearly 25%. Iraq, Saudi Arabia and the UAE have all recorded steep output declines, highlighting the scale of disruption across key producers. These producers have now turned to alternative export lifelines. Saudi Arabia is ramping up flows through its east-west petrol line, routing crude into the Red Sea. The UAE is pushing exports via the Fujairah pipeline, bypassing Hormuz entirely. And Iraq continues to rely on its northern route through Turkey to access Mediterranean markets. But these alternatives come with limits. Combined, these pipelines can move roughly about 6 to 8.5 million barrels per day at best. That's significantly lower than the 20 million barrels per day that typically flows through the Strait of Hormuz. The disruption is hitting oil importing economies the hardest, especially in Asia. The reason is simple. It's the simple understanding of how the supply chain works. Oil is a key ingredient for almost every industry. But beyond oil, fertilizers, chemicals, gas, and several essential commodities that pass from the Gulf are now missing from the global supply chain. While the immediate impact is highly visible across export-heavy industries, across economies, the long-term impact could be more dangerous.
It's important not to forget all the other sort of energy streams that are being affected potentially in even more critical ways than oil is right now. One of the principal ones is, gas and liquefied natural gas with, a key producer globally, Qatar, shutting down effectively its production through a mixture of, attacks in the region and the inability to export. About 20% of the world's liquefied natural gas passes through the Strait of Hormuz on a daily basis as well. So the impact that this has on several different industries is critical.
An oil shock rarely stays contained. It spreads across the economy. It starts with crude. Higher oil prices push up fuel costs, petrol, diesel, aviation fuel. That feeds directly into transport and logistics, raising the cost of moving goods globally. The next come industry. The oil-linked inputs like plastics, chemicals, and fertilizers become more expensive that drive up the manufacturing costs. Food inflation follows as higher fertilizer and transport costs hit agriculture. Central banks are then forced to respond with tighter monetary policy even as growth slows down. The result is the classic macro shock involving high inflation, slowing growth, and rising stagflation risks.